The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Welcome back to the Senior Show with two wild and aging guys. Hi, I'm Neil Himmelstein, owner of Main Street Planning Group and host of the Main Street Code for Financial Success, here with my partner, Tim Kennedy.
Yeah, man. Tim Kennedy here, and I am your certified reverse mortgage professional. And Neil, we've been doing this, gee whiz, are we 6 months into this thing?
I think so.
Yeah, this Senior Show, where we are two wild and aging guys. And the whole premise of the show is for the listeners to realize that, their change occurs, and we have no control over it.
Right. You either embrace it and navigate it, or we
put your head in the sand.
Which
is not what to do.
Right. Well, what's interesting, Tim, is last week on my show, one of the most disturbing things to me is the amount of debt we're in as a country. I mean, $40 trillion.
Just surpassed $40 trillion.
$40 trillion, and going strong, because in order to. And what the government's doing, it's just mind-boggling, because they're issuing more and more treasuries, right? And when they do that, the yield goes up. And when the yield goes, one thing happens, another thing happens, another thing.
It all compounds on top of each other, yeah.
And when the yield goes up, what happens to mortgage rates?
They go up.
Up. And what happens to the stock market? Curiously enough, when yields go way up, a lot of money shifts from the market to chasing these yields, and there's a lot of foreign money coming in, buying our debt, which is scary. The worst thing is to owe somebody money. We hate that, right?
Especially our adversaries.
But how do we, with all this change, benefit how can that benefit us whatsoever? I mean, I talked about a flight to fixed investments like fixed annuities, but I think you have another possible solution of something that we can do.
Yeah, so we talk about it all the time. So in the mortgage industry, we focus primarily on the Treasury, right?
Right.
And what happens with that rate? It's always funny when you always hear these big announcements. Oh, the Fed just cut the rates a half a point. Oh, the Fed is keeping the rates the same. And when I was doing like my forward mortgage business, traditional mortgage, conventional FHA, I would always get these phone calls. Hey, Tim, I just heard the Fed cut the rate a half a point. Does that mean my rate comes down half a point? Well, no. Right? When they're cutting that rate half a point, that's not talking about rates on a fixed mortgage, so to speak. It's really the money that the lenders lend between each other, right?
It's more, and it was more of a short-term rate, not a long-term rate.
Exactly,
which what a mortgage is, right?
But with the reverse mortgages, and this is the part where I try to really explain, because it's really one of the best kept secrets of the reverse mortgage, is that available line of credit. Because that line of credit has that guaranteed growth rate factor to it. So in this scenario, right, if interest rates go up, which they have been going up, right, in small increments lately, on the reverse mortgage line of credit, that interest rate also increases, which gives you access to more funds, later on in life when you may need it.
So let's use an example. Let's say we have a 61-year-old and... Well, they can't get it at 61 years old.
Well, 62, right? Yeah. Well, I wasn't going to correct you, Neil, but I was just going to read to qualify for the home equity conversion mortgage, one spouse has to be at least 62 years of age.
Okay, one spouse, not both.
Just one. Yeah.
Okay. So let's say you have someone who's 62 years old, and they have a home here on Long Island, which maybe they paid $200,000 for, and it's now worth $1 million.
Now worth $1 million.
Okay. And they're not quite ready to retire. They don't need the money right now, but they can open up a line of credit, let's say for $500,000, can they?
Well, at 62 years old, they'd qualify for about 35% loan to value, so $350,000.
So maybe their home's paid off or they have a small mortgage. They open up a line of credit for. They don't have to use that right away.
Don't
right?
have to use it. So
Okay.
I currently have clients like are at like 58, 59, 60, 61, where they can't wait to apply for their reverse mortgage at 62 because they want that line of credit.
So you get that line of credit.
And now they're
At 62,
hoping and praying rates skyrocket.
Right. So at 62, I have a line of credit for $300,000. Okay, I'm now 65. I'm thinking about retirement, and the interest rates go up to 7, 8, not maybe even. Let's just say, just for argument's sake, let's say they go up to 10%. Only for mathematic reasons. So, if it's 300,000, it's 10% next year. It's 330.
That's right.
That's my line of credit. I'm not touching it.
Right now,
I'm not paying for that.
And now it's compounding.
And then the following year, it's 33,000 plus 330, so it's 363,000.
Right.
Line of credit, not using the money.
You're 63, 64. You're probably still working, maybe. Right.
Right.
You're not drawing against it. You don't need it.
65, now it's compounds again. 36, so now it's up to, 400,000.
400,000.
Okay.
So now let's put that into let's speed dial that thing. In 10 years, that $300,000 could very easily be well over $600,000.
Correct. Or isn't that the rule of 7 or something?
Yeah.
Okay.
Yeah.
That's at 7% for the next 10 years.
So it'd be that much.
Or 10% for 7 years.
Right. There you go.
It doubles. So with that compounding effect, without you touching it, now you have some money. Now what can you do with that line of credit?
Neil, you can do anything you want with it, and it's tax-free money.
So, okay. So now I'm retired. I'm 65. I'm 70 years old. I got this mythological bucket of money.
This fun money.
And I buy a condo, not in Florida because those prices are out of whack now.
Can't get homeowners insurance.
South Carolina.
Well,
and
yes.
I use that money to buy that.
So, Neil, you could use those funds for anything.
And
right?
I don't pay tax on it.
And you're not going to pay tax on it.
But I have to pay my money back, don't I?
Well, of course you do. Any money you borrow, you're going to pay back. But that money gets paid back when you or the last surviving spouse leaves that home permanently. But you're not going to pay it. Your kids aren't going to pay it. The sale of the home is going to pay that mortgage back. And then any remaining equity in that home would go back to the heirs or to the estate. Remember, we don't own the house, right? We're just the lender. The homeowner owns the home.
Right.
But the whole premise of that line of credit and that growth rate, especially now we'll talk about doom and gloom, right? The 40 trillion and this, but let's look at some positive sides of this thing, right? And one of the ways is accessing the equity in the home with this line of credit, creating this growth rate, creating this other bucket money, tax-free money, like you talk about all the time, all the other tools that are in the toolbox to create this tax-free money. What other tools are there instead of dipping into that investment portfolio? Possibly, if you're drawing money from your investments and the stock market takes a dive, and now you're concerned about sequence of returns risk, But if you had this other buffer, this other bucket of money, this buffer asset,
right?
Now you leave your other investments alone. Don't touch it, right?
Yeah. Now another
you never want to touch your money in a down market.
Yeah. Another interesting thing I thought is there are a lot of 50, 60-year-olds that start to understand because their parents are older and usually in the zone, and they start needing long-term care. Their parents, typical, not, 65 you start seeing it, but 80 is really, 75 is a sweet spot. Hey, your body starts to deteriorate, the mind starts to deteriorate, and there's long-term care, and everybody sees the expense. And then hopefully, if they're smart enough, they'll buy some kind of long-term care protection.
Right.
But what if they can't get it? The nice thing about a long-term care insurance, whether you buy it with a combination life insurance or a standalone long-term care plan, like we talk about on my other show all the time, is that the benefit is tax-free. It's a great benefit to have. But what if I can't get it? And I did this. I can still access tax-free money down the road.
To pay for your
to pay
Long-term
for my
care.
care.
Right.
Okay.
And or Neil, let's
Without
say,
selling my assets. And the biggest problem we have is that most people, because this is what they were taught, do two things. They try and pay off their home, or they push all their money into retirement accounts that are taxable when
That's
they
right.
take them out. So the last thing you want to do is take them out when you need it and be taxed on it.
That's right. Hey, Neil, coming to the end of the show. We'll be right back. But my name is Tim Kennedy. If there's something I said that piqued your interest, give me a call, 516-729-6040, or you can reach me at timtalksreverse.com.
And this is Neil Himmelstein of Main Street Planning Group. We're your insurance specialists, so life insurance, long-term care, disability, life settlements. If you need to sell your policy, best way to reach me, 631-647-4694. Welcome back to the Senior Show with two wild and aging guys. I'm Neil Himmelstein. We're here with Tim Kennedy, and we were having a great discussion about what, Tim?
Well, we were talking about ways to access tax-free money. And the idea, you just left off with the idea of if somebody is trying to process or qualify for a long-term care policy, what if they don't qualify?
Right.
Well, maybe you create this buffer asset, this line of credit through the reverse mortgage with that guaranteed growth rate. And if and when you need long-term care, whether you or your spouse, now you have this other bucket of money, tax-free money. That could be substantial money, 5, 10, 15, 20 years from now when you need it.
And that's important because what I was about to say before the break is that most people in the last 20 years have been pushed into IRAs, 401ks, and rightfully so. Great tax-saving vehicles. You took tax deductions and everything else.
It's awesome right now.
Right. But when you're ready to take that money, not only is it taxable, but if you hit a down market, it could devastate your retirement because as you need to pay for long-term care and you drain that account and you hit a down market and you pay taxes on that money,
right? So
that money disappears very quickly.
Neil, right now, what is the worst case scenario if somebody were to retire right now, right? Inflation. Where's inflation right now?
Right. Inflation.
Interest rates are increasing.
Right.
And then what happens when the stock market starts taking a dip?
Which is going to do.
That is your worst case scenario if you retire today.
Right.
Right. Your best case scenario would be for inflation, I guess, to level off.
Right.
Interest rates to level, and then the stock market to just stay at a steady pace.
Which it never does.
Which it never does, right? But the idea is how do you hedge your bet and how do you protect yourself from the, because you always want to protect yourself from the worst case scenario.
Right.
And how do you do that?
And the way we're heading right now, as we began the show, with the debt the way it is, with the interest rates potentially rising even further, not the short-term rates, the borrowing rates and everything else, which will, most cases, drive up inflation if we put all the factors together, we're headed for a tsunami. Are you prepared for that tsunami? And Tim and I want to give you some bumpers to protect from that tsunami. But I wanted to talk about one other thing because this came up with an insurance company yesterday that boggles my mind. And a lot of times people don't understand it until they're in that latter stage when they talk about qualified money versus non-qualified money. And people don't understand the meaning of that. So qualified money is money that was you took taxes out ahead of time that were pre-tax, like your IRA, your 401k, your 57, your 403b rather, if you're teachers and doctors, then you could take out a 403b, which is similar. And all these retirement funds, except for Roth, are considered qualified money. Now, the word qualified means tax qualified. It also means I'm going to get taxed to all hell when I take that money out. Okay? So that's what qualified means. Non-qualified is life insurance, cash in the bank. That's non-qualified. Where that makes a difference, and where
Neil, growth rate on a reverse mortgage line of credit?
Non-qualified. So where does that make a difference? One difference is, as we said, when you need the money and you want to withdraw the money. Also, non-qualified monies doesn't affect your IRMAA costs.
We discussed that a couple of weeks ago.
Yep. So, but at death, that's the biggest thing, because both your qualified and non-qualified money can be estate taxable, but your qualified money becomes income taxable and estate taxable, and that leads to a lot of problems in estate planning when people think, I'm putting all my money in this one bucket, and they never took money out of their qualified bucket, can leave a tax burden for the next generation, and does. So you really want to do some planning on these different buckets. And Tim adds a whole nother bucket to the conversation, which is why you don't work with one person who's a financial professional. I had another person who called me.
Hold on, I don't want to cut you because it's just a thought popped in my head. I always talk about the home equity of homeowners over the age of 62. There's almost $15 trillion of home equity that homeowners today over the age of 62 they can access and use and put towards their retirement income plan. And we're talking about $40 trillion in debt, federal debt, right? But homeowners over the age of 62 are carrying $15 trillion. That's a tremendous amount of money, and we should be talking about that. That should be part of the retirement conversation. What are we doing with that equity? Because you say it all the time. The kids don't want the house.
Some of them do.
They want the money for the most part.
Yep.
Right? So why not institute that? Why not put that into part of your retirement income plan?
It's a great idea, and it's another tool in the closet. But people try and a lot of financial advisors act in a vacuum, and I know where I had this conversation right before the show. I had a rep that called me. He's 75 years old. He's mostly done health insurance his whole life, and his client is an attorney. And his attorney's asking him for term insurance. His attorney's also wondering about long-term care. And he thinks he's going to explain all this without training to his attorney. I told him, listen, let's talk to the attorney together. He says, well, I mean, he's an attorney. He's very successful. He's got this money, this money, this money. So
Neil, hold on.
He's got financial advisors. I go, it doesn't sound like it if he's asking you for, I hate to say, it doesn't sound like if he's asking you for life insurance, he's asking you for long-term care. It doesn't sound like he has a financial advisor.
So Neil, let me ask you a question. How much would it cost him to get you on the phone for advice?
Nothing. So
no cost, no obligation to have that conversation.
None. So the point is, you need a team of professionals sometimes to help you. And people assume because people have a lot of money that they know what they're doing. And I got to tell you something. I've run into more attorneys. I'm picking on attorneys because everybody, the outside world may think, well, the attorney knows about planning. The attorney could be a real estate attorney, and he's trying to draw up his own wills. He's never drawn one, and he goes on Google. Well, I can do that myself, and then they end up.
Yeah, no disrespect to attorneys, but a lot of attorneys stay in their lane, and they're specialists in what they do in law, just like a doctor.
Right.
You're not going to go to a podiatrist because you have chest pains.
Right.
You got to make sure you go into the right for the right purpose.
Right. So Tim and I both take a really holistic approach to financial planning. And neither one of us is an investment advisor. And people think, oh, my investment advisor knows everything. My accountant knows everything. No, your accountant tries to keep you from paying taxes. Okay?
I was on a call yesterday.
Your attorney tries to get you on Medicaid. Okay? We try and have you keep your money. and use it for your own livelihood.
I was on a call yesterday, Neil, with a team of financial advisors up in White Plains, and we had a great call, going back and forth, all like this, right? What we do. And this morning I get a phone call. I get a text from he goes, I was up all night. Can we talk? And I got him on the phone. Oh, man, we're coming to the end of the show. But anyway, he thought I was a financial advisor. I said, no, dude, I'm just a mortgage guy. I'm just a reverse guy. So, hey, I am the reverse guy. I am Tim Kennedy. I am your certified reverse mortgage professional. I can handle all your reverse mortgage questions. Or reach me at timtalksreverse.com, 516-729-6040.
And I'm Neil Himmelstein, owner of Main Street Planning Group, also host of the Main Street Code for Financial Success. I'm a life insurance wholesaler, and I help people with all their life insurance, disability, long-term care, and annuity needs, completely independent. I represent 30 different insurance companies, and I tailor the program to fit you, not the product to fit you, the program, and put together the advisors that you need for you to be successful.
There you go. Hey, Neil, and who are we? We are two wild and aging guys. I'll see you next week.
Thanks.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.